Investing is one of the few business activities where most participants are amateurs and therefore rely heavily on outside advice. Chapter 10 walks through the different kinds of advisors you are likely to meet, what they can realistically do for you, where their conflicts and limits lie, and how you, the investor, should think about using or not using their services. The chapter's central message is simple and steady. Advisors can be useful, but they are not miracle workers. If you pay for advice, you should expect safety and competence. If you don't pay, don't expect miracles. And always bring your own judgment to the table. First, Graham separates the professional advisory universe into broad categories and describes what each typically offers. At the conservative, high-price end are established investment counsel firms and the trust departments of large banks. These organizations tend to behave like traditional custodians of wealth. They place most client money in leading companies and high-grade bonds, avoid flashy market timing, and aim primarily to conserve capital and produce steady income. They are not, generally, in the business of promising outsized returns, and that is precisely their value for the defensive investor who wants steadiness and protection from costly mistakes. A step down in cost, and a step aside in role, are the financial services. Moody's, S&P, Babson, etc. Some of these compile and publish the statistics and ratings that underpin serious security analysis. Others send out market forecasts and stock tips. Graham cautions that forecasts and timing calls are mostly entertainment for the markets. Their useful function is supplying information, not telling you when to jump in and out. A sound investor uses these services as sources of data and perspective, not as a substitute for his own appraisal of price versus value. Then come brokers and brokerage houses, the biggest source of everyday advice for most people. Here Graham is candid and practical. Brokers are paid by commissions, and commissions have historically pushed firms toward speculative, trade-oriented behavior because that's where the volume and fees are. That doesn't mean every broker is a salesperson or a bad actor. Many are highly ethical and helpful, but it does mean you, the investor, must be explicit about your goals. Say you're a conservative, value-oriented investor, and the broker will adjust. Otherwise, the tendency will be to nudge you toward frequent trading and short-term tips. Graham also explains the crucial difference between being a customer, a consumer, and a client, a professional relationship, and argues that investors should treat their relationship with brokers like a professional engagement. Closely related are the security analysts who produce in-depth company research. Graham, himself a former analyst, emphasizes that analysts can be extremely useful, but their value to you depends on the questions you ask. If you ask, "Will this stock rise next month?" you're asking the wrong question. If you ask, "Is this company priced sensibly relative to its long-term earnings and balance sheet?" you'll get the kind of analysis that helps an investor. The chapter also notes an important development, the CFA designation created to raise professional standards for analysts, which helps consumers identify better qualified analysts. Investment bankers and underwriters occupy another role. They originate and sell new issues. The chapter treats them as honest business people who perform a constructive service, raising capital for industry, but warns that when they sell to the public, they are also salesmen. The public buyer should therefore verify underwriting recommendations rather than accept them uncritically. A few practical safety points stand out. Graham recommends that non-professional investors not carry margin accounts and, as an extra layer of protection, have their bank act as the actual deliverer and receiver of securities. For example, custodian settlement. This costs a touch more but adds safety and peace of mind. Another sharp warning in the chapter is about the financial health of brokerage houses. Partners sometimes held speculative stock positions that could, and did, erode firm capital, causing failures that harmed clients. That history argues for caution in choosing and monitoring the firms you deal with. The chapter closes with a clear summary. If you pay for an established investment counselor or bank trust, you can expect conservative, competent handling, roughly consistent with what a prudent, well-informed investor would do for himself. If you rely on unpaid advice from brokers, friends, or free newsletters, don't expect better than average results. Above all, avoid anyone who promises spectacular gains. That's the voice of speculation, not investment. The commentary updates Graham's tone for contemporary readers. It begins with the realistic question: Do you need an advisor at all? The answer is personal. Advisors help most where the investor has messy finances, chaotic or undiversified portfolios, major life changes, starting a business, retirement, estate needs, or simply needs the behavioral discipline a professional brings. One of the biggest benefits of a good advisor is psychological. They keep you from doing the very thing that ruins many investors, buying high in a frenzy and selling low in a panic. Trust, then verify, is the commentary's operating motto. Do due diligence. Check disciplinary records, SEC Form ADV for planners, state regulators for brokers. Search for complaints and ask for references. The commentary also gives practical red flags, phrases, and hard sell lines that should make you walk away, and recommends that upfront fees be made transparent. A useful rule of thumb spelled out in the commentary is that if advisory fees will consume more than about 1% of your assets annually, you should shop for alternatives. When interviewing an advisor, the commentary says, don't let charm substitute for substance. Ask about philosophy. Do they index or try to time markets? Services. Do they do taxes, estate planning, budgeting, and costs? Ask how they choose investments, how they handle poor performance, how many clients they serve, and how they are compensated. Good advisors will ask you hard questions in return: your goals, budget, risk tolerance, past mistakes, and how you reacted to recent market declines. That two-way vetting builds the foundation of a useful relationship. Finally, and perhaps most practically, the commentary reframes the advisor's job. You hire an advisor not merely to pick stocks, but to manage you, your impulses, your biases, and the behaviors that cost you money. A high-value advisor helps you build a financial plan, an investment policy statement, and an asset allocation schedule, systems that remove emotion from the most dangerous investment decisions. To conclude, advisors can add real value, especially for complex finances or for emotional discipline, but they are not miracle workers. Use paid, reputable advisors for conservative stewardship, treat free advice skeptically, do your homework on credentials and fees, and insist that any advisor you hire helps you create a written plan and the behavioral guardrails that keep you invested through good times and bad.